Hello and welcome to ATF TV. I'm Christine Zhou, and today we have with us Alvin Yeo. Alvin is the head of Green Sustainable Finance Debt Capital Markets for Asia at UBS Investment Bank. He joins us from Hong Kong to talk about why a holistic approach to sustainability with respect to environmental, social, and corporate governance, or ESG, is now an important consideration when identifying investment opportunities. Welcome to ATF TV, Alvin.
Hi, Christian. Thank you very much. I'm very pleased to have the opportunity to speak with you here today.
Thank you, Alvin. So, Alvin, our first question. As businesses globally lean closer toward green and sustainable lifestyle themes, how has the pandemic influenced the appetite for sustainability-linked bonds among ESG-related investors?
Yeah, so I guess if anything, my conversations with both issuers and investors suggest that the pandemic has reflected growing awareness of the impact of human interactions with the environment, and as a result, it's quite likely to push investors to consider more deeply the importance of sustainable investing. I think increasingly investors are also more proactive in signaling to the sell side that they are keen to participate in this asset class from an investing standpoint. We've seen an uptick in reverse inquiries where investors basically come to us and say, hey, you know what, we have this issuer that has an existing green bond framework. We noticed that they have not come to the market for a while. Will they have any interest for a new issuance in green format? So I think that clearly is a sign, because I think they could have come to us with regards to, other kind of products. But I think increasingly we see more and more asking about green bonds, any issuers that like to come forward, with proposals that they can consider.
Has this impacted the pricing between green bonds and conventional bonds?
I would say that on the pricing differential in the primary markets, we have yet to see kind of a meaningful cost savings for issuers when it comes to new issuances. But I think it is fair to also mention that we're starting to see for some time now that green bonds are gradually trading tighter than conventional bonds for the same issuer in the secondary market. But I think the argument that for a green or ESG related primary bond deal, the ability for the same investors looking at a transaction to participate across both conventional and ESG dedicated fund mandates also means that issuers can potentially attract a larger order book, which I think in turn gives them further leverage on tightening from initial price guidance to where they finally land. So I would say the ability to attract both a wider investor base as well as a larger order size from the same investor umbrella does contribute to stronger order book dynamics where issuers could potentially use them to leverage the final pricing for primary transactions.
Thank you, Alvin. And our last question, what are some of the challenges in the development of sustainable finance in the region?
So let me break it down into two different market participants, right? So I think on the issuer side, I see two key bottlenecks, right? So number one is when it comes to looking at the use of proceeds oriented framework, which I talked about earlier. I think some of the borrowers struggle to find sufficient use of proceeds to justify raising a green or sustainable bond, because I think practically speaking, you also need the bond to be sufficiently liquid, so it needs to be of a minimum size. So I think looking at it from a different angle, such as a sustainability link target approach in an SLB structure could mitigate such issues, right? So I think issuers sometimes also find it hard to justify to other stakeholders that why are they spending more time and effort to issue a ESG bond when there is no clear pricing benefit. I think as investors call for more ESG bond supply and as more ESG oriented liquidity surfaces, I think issuers will start seeing more meaningful pricing benefit. I think government grant subsidies such as those provided by HKMA as well as the MAS also helps to offset incremental costs for ESG bond to a certain extent. So I think issuers can rethink the amount of effort and resources, as well as the incremental cost that they have to bear for a green bond, and how they can sort of offset this with some of the other more, sort of tangible benefits. I think on the investor side, the lack of a consistent framework and inability to measure and compare issuers' ESG performance makes it hard for them to incorporate the ESG investment into their analysis and investment decision. But again, I think the sustainability-linked bond structure here provides some comfort, as issuers have a natural incentive to meet certain sustainability targets that he has set. So I think there's an alignment of both, the issuers' willingness to commit to the target that they set, as well as the investors' sort of level of comfort that there is sufficient incentive for the issuers to do so.
Thank you, Alvin, for being here with us today. That's all the question we have for now. We hope to have you back with us again.
Thank you very much, Christine. Thank you.
And thank you all for watching. Please check out asiatimesfinancial.com for the best Asia news on markets, economies, and more. I'm Christine Zhou, reporting for ATF TV.